Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today on the program, we speak to longtime portfolio manager Steve DuFour, who manages the U.S.-focused stock fund. Steve shares his perspectives on the current inflationary environment, the earnings cycle, and what the upcoming presidential race could mean for the U.S. economy. Steve explains how the U.S.-focused stock fund is a concentrated fund comprised of 36 stocks. His niche is finding companies with strong relative earnings. For him, he spends time looking at companies with good balance sheets and good earnings. He's not necessarily latching onto current trending themes. For him, he meets with the company leaders, looks at company earnings as a whole, and from there discovers what the themes are driving the company's success. Steve also touches on the impact of AI, why he invests in healthcare, utilities, and REITs. This podcast was recorded on July 17th, 2024.
U.S. focused, sometimes we call it concentrated. Just tell us a little bit about the fund itself, if you don't mind. Remind us.
Okay. It's a concentrated fund, primarily U.S. stocks. I try and own, and it's a discussion for another day, but I try and own 36 stocks. My niche is companies that have strong relative earnings, trading at attractive prices. And that was an area of the market that I specifically chose as I entered in this concentrated investment field 18 years ago, because I think it gives the investor...
Half of 36. Anyway, yeah, carry on.
All right. It gives the investor a good understanding, a good exposure to good upward movement and great themes in the market, but it also protects the downside, which is something you really need to spend a lot of time in concentrated funds, is how do you protect the downside?
Right. And I mean, actually for days like today, because it's sort of a bumpy ride today. We mentioned in the intro there that AI is a theme that should indeed go on for a long, long time. Those are your words to an extent. Tell us about themes, about your style of investing, how themes fit with it ultimately. I mean, AI is the theme we're talking about today, but just sort of more broadly.
Yeah, I've said in the past, and I'm repeating myself, but I don't try to dictate the themes that go into the market, into the fund. I tend to invest in companies with strong relative earnings and then find out what the themes are that are driving their earnings growth. And then I may look for similar companies to the ones that I've invested in to continue on with that path. But when there's a new theme that comes into the market, whether it's marijuana stocks or fake meat stocks or whatever it is, I'm not saying to myself, well, that sounds like a great theme, I should go buy those stocks. I buy stocks that have strong relative earnings, and then you find out that they're being driven by AI, they're being driven by a new type of healthcare product, they're being driven by electrification or EVs or something, and then as you own a few of them, you say, wow, we now have a theme in the fund. So it's a technicality, but it's very important.
Yeah, it's a really interesting perspective, actually, to go at it from that perspective rather than sort of sticking it with the theme. As you say, that almost comes in a secondary manner. Go into a little bit about how the AI theme that is playing out right now, and there are good days and bad days, what the backdrop is for you. And I recognize that you're not spending, when you have 36 stocks, all of them have to have earnings, and you have a very specific way of looking at things. You're probably not spending endless amounts of time on the macro picture. But there are a few pieces of the story that are right in your face. What are those? How do you have them as a backdrop for what you're doing today?
On the macro side? Yeah, so this is as I was explaining, this period between now and basically November is a very turbulent time. I always say that I invest in the fairway, but you also can say in boating, you want calm waters. But this is a very unique time because you've got three countervailing forces affecting the stocks, and that's why they're being very volatile. The first is the Federal Reserve, and the Federal Reserve took us from zero interest rates to well over 5% in the fastest time ever. And now they're waiting for data to take it back down to some new number. So we're all waiting for that, and that is going to affect some industries, particularly ones that have financing, whether it's autos or housing or things like that, where if the cost of borrowing goes down, there's a potential that the volumes go up. So that's one thing happening. The other side, you have a presidential election where in this country, and this is a U.S. focused stock fund, presidential election where you have two parties that have very different views on things like electric vehicles, solar, wind, the energy industry, tariffs, you name it. And so you need to make sure that you understand what the implications are of either the current party having another 4 years or a change in parties on that. And then in the middle, which is what we do, because this is something I can't predict. This is something I can't predict. I have to understand, but I cannot predict. What I try and predict and what I try and do well is earnings, earnings, earnings. And so, but the earnings are going to be affected by interest rates, and the earnings in some industries are going to be affected by the elections. So you have to understand what the implications on your thesis for owning the stock is in all the different scenarios that you can't bulletproof the portfolio, but you at least understand what exposures you're taking in.
You mentioned earnings there, which is exactly where we are, and how important that is to everything that you're doing, because you don't invest in things that are not profitable ultimately. So what do you think of earnings right now? I mean, it seems like there's a lot of powerful tailwinds going on here, but give us the broad take and then zero in a bit on what you're investing in.
I'll give you one word: awesome. So if you're in the right part of the market right now, with companies exposed to some of these strong themes, you have more demand than you have capacity. You're experiencing pricing, you're sold out, you're expanding, and things are very, very good. So it's kind of a tale of two cities, but that's on the thing. On the other side, if you are exposed to industries that that revolve around interest rates and borrowing to buy the product, whether it's a car, a boat, an RV, a house, whatever it is, you're not as happy as other people. But as we talked off about AI, we are in a technological change. We went from a world before the internet to the internet. We had a long run with the internet, and the internet changed all of our businesses. Before that, we didn't do e-commerce, and now all of us do 32.5% of all our transactions are in e-commerce. And so AI, we don't know the exact trajectory of what it's going to change, but it's going to change a lot of the ways we interact for business and processes. And it's exciting, and people need to change the way they compute, the way they do their data, and the way they interact with their customers, and the way they train their employees. There's just going to be huge changes, and if you're involved with that, your headaches are too much demand, not too little demand.
Right, those are better problems to have. So does that mean ultimately that you're taking a look at the big companies that do have earnings? They are absolutely profitable. They've got so much cash flow, they don't know what to do with it, literally, and they are at the AI forefront. I mean, do we assume that's where you are in your concentrated fund? Give us a sense of your positioning to the extent you can.
Yeah, that's it. And then you have to do a lot of thinking about what's going to change. How is this going to affect software? Don't know the answer. How is this going to affect some of the search? Don't know the answer. How is this going to affect some types of consulting, some types of advertising? If you can develop an AI-generated advertising campaign with one person and an AI machine, and you can do it in 10% of the time that an agency did it with a lot of people, maybe the agencies are not going to be as good. And you can say the same thing with law firms. You can say the things maybe with call centers. So I need to understand the winners and the potential losers. But there's endless ways. People say AI and they think of chips. So our largest holding is a chip manufacturer, NVIDIA. But AI is going to move from chips into data centers, into data, uh, uh, the way data organization, to then actually into products, and then products into winners and losers. But we are years away from that actually happening. We're basically setting up the table for the meal, and right now the table's still being set.
Right. Are the candles lit at this point, or just
no candles lit?
No, we're still...
All they've done is put the placemats down, and your third child is putting out the knives and forks. That's where we are. No one has lit the candles.
Fantastic. I love this. I hope we get invited to the party. It sounds great. How about one of the pillars of what you were talking about, these sort of three backdrops of the macro story, which is rates, we think, being cut, and potentially a rate cutting cycle. You've got the AI, it's a 10-year story at least, if not longer. But then you've got, interest rate sensitive stocks that I'm sure within your 36, it may have some impact. Like, how do you deal with that? Do you pivot away from something? Do you just try to include them?
No, it's just a different bucket. So
Okay.
you have in your fund, when you have your fund, you have 2 or 3 different types of buckets. And one of your buckets is, one of the biggest buckets is secular winners with strong themes, and whether it's healthcare innovation, electrification, or AI. But then you also have a bucket, and it's usually a smaller bucket, but that's basically you can call it cyclical recovery. You can call it a lot of different things.
Right.
But these are good companies in decent industries that have basically had experienced a number of years of headwinds, and the headwinds are changing, and so they're going to have 1 to 2 years of very strong relative earnings growth. And I'm not opposed to adding them to the portfolio to supplement the returns of the fund. And the key, you just have to remember yourself, is it's a trade and not a long-term investment. So you have to have very tight price targets, and you have to remind yourself to sell, and sell.
Okay, so yeah, there's a dynamism there that you have to worry about. Are there things that that's sort of the pivoting of the theme, if needed, ultimately? What would you say? We'll come back to more what is very investable right now, but are there areas of the market that are just, particularly for a fund that's concentrated, what is absolutely not investable right now?
2 parts of the question, and I'll answer a little different than you asked it, but I think I'm getting to it. There are things that will never be in the fund. So
Okay.
We start with earnings, and we also try and get rid of anything with kind of like binary decisions. It's like, as you talk about the presidential election or something like this, I need to own a pretty large position, and I spend more time on the downside than I do on the upside. It's easy to find stocks that have upside. It's very hard to find companies with upside with limited downside. And so we don't own companies that have a lot of fashion in them. We don't own companies that have in the biotech industry where we're waiting for a drug to be approved or not approved. We don't own a lot of media companies, whether the movie's going to be a good movie or a bad movie. We don't have a lot of that stuff. It's more steady Eddie stuff, and because that allows us to have a decent sized position. And yes, we may miss them because a number of them are going to go up 30-40% when they get the yes versus the no decision. But in order to do the investing in yes/no decisions, you need to have a basket of about 10 of them, and you're going to get 3 or 4 good yes/nos, and they offset the losses of the no's. But if you're trying to pick one stock, my ability to pick the one stock that's going to get a yes over the 7 or 8 that are getting no's, that's not something I would think I'm very good at. I buy more very good companies that are going forward, and we avoid companies with bad balance sheets.
Right.
We avoid companies that don't have free cash flow. It's a pretty narrow universe of names that people know. I mean, as you go down the top 10, NVIDIA, Microsoft, these are names you know. I just have a differentiated opinion about the upside of earnings than the market.
Right. So within the universe of equities, you've got investors that will have different types of investments within their equity side of their portfolios. Where does your fund fit ultimately?
Can you rephrase that?
Yeah.
I don't.
Yeah. Where do you think your style of investing and this is a core holding? I'm assuming. Is there, if you were to say, where does this fund fit in advisors speaking to their clients? Where does it fit in a client's portfolio? Your fund.
I wish it was core, and I'm hoping it's core. But what I've said over the years, I'm going to stay with my thing is, if I was building a portfolio, I would have a scoop of value, a scoop of this, and I would view the focused U.S. focused fund as kind of the whipped cream and the chocolate sauce and the caramel on top. So I don't think it can be the foundation, but I think if you look at returns of what the fund's done and which markets it does well in versus markets it doesn't do well in, I think it will augment the taste of any portfolio, and actually really enhance the enjoyment of a portfolio. I don't think it's going to be the core building block, but I hope it is, because love to see it.
So within the top 10, a lot of them are kind of the household names within the tech universe. What drove the move towards industrials versus tech and financials? Is that a good summation, would you say, of what's there?
Oh, we were a year or two ago, we were 1,000 basis points, our largest weighting in the fund was technology. Fast forward to today, our largest overweight is industrials. And so there are parts of industrials that are going to do all of the implementation of this new world order, whether it's electric cars, whether it's data centers, whether it's AI, reshoring, all of that is going through a number of things. I was on the way into work this morning. I was listening to someone who's building data centers for AI, and someone asked about chip availability like this, and he said that one of the things he was very excited that he was able to procure transformers. So he's not talking about the computing power. He's talking about the ability to get electricity to his building.
Wow.
So there are parts of and a lot of these businesses are really enhancing their margins. So they have fixed costs in production, and then you get the higher volume, and you actually make more money. It's kind of counterintuitive, but you make more money in that. And the second thing is within, I talked before, but within technology, there's a lot of companies that I'm worried that they're going to be it's going to affect their business models, this new AI. And so there's whole parts of technologies that I don't think I need to invest in at this time. Mm-hmm. So as I looked at the map of where this was going and following the earnings, it drove me to industrials and out of parts of technology. We still have you see the top 10, we still have huge weight in technology, but nowhere near where it was, and it's different. Industrials look like they have a very good run.
Fascinating. Great to have you flesh that out for us. Any comment on China? Would another trade war with the U.S. impact the fund?
A trade war with China would affect the fund, and it would to the extent it affects the economy, it would affect the fund.
Right.
There's no way I can say that it would not. But there have been trade wars on a number of different items. The one that reminded us less than 12 months ago is we did something to China, so China stopped importing DRAM from the United States. Right. It hit the stocks, and then fast forward a year later, business was so good that they didn't need to send those chips to China anyway. So it depends exactly what items. The companies, the countries are very good at making big statements and then picking exactly products where we're not going to import any more lobster from Maine, or we're going to very specific things that in the end it's just not that many lobsters that are sold to China and stuff like that. But it all depends down into the details of what they do. But this is going to be this is not going away. This is
Right.
going to be around for a while, and so you have to understand early on what your company's exposure is to China, and so that what the downside is if it does go away.
Yeah, and get out of the lobster business if you have to in advance. I wanted to come back to the strong relative earnings growth that is it sounds like your North Star there. How does that help going through bumpy bits? So, I mean, it's really the recession question. So if something hits, ultimately, because you're choosing companies that would have so-called less risk because they have the earnings power and they've got that steady eddy aspect to it, presumably they would come through a recession better. But take us through your thinking on that and ultimately how that works.
Yeah. So as long as you have the valuation correct, and I've done this now for a few cycles, and this is no prediction of the future, the fund, if you look backwards, has done well going into a recession because of what you just said, is that we have companies with secular growth, and the companies with secular growth are actually feeling the effects of a downturn or recession more than the ones who are benefiting from new investment ideas. But that's as long as you got the PE correct. If the PE is correcting, you may have the earnings right, but you get the PE wrong. So that's a big caveat. But that's what the thing is. The actual for this fund, the part that I'm trying to get better and better at is actually coming out of recessions. So when you come out of a recession, a lot of the companies with bad balance sheets, a lot of the companies that have gotten really hurt going into things, they actually, as the economy starts getting slowly get better, they actually do proportionally better than the secular winners. And so as we head into, I don't see a recession right now, but my ability to predict that is zero. I worry more about being prepared to come out of a recession than worry about going into a recession, because we don't typically own low margin, high debt companies that when things get tougher, that it's people start questioning whether they're going to be a going concern, and stuff like that. That's not an area we play in at all.
But you're getting better at, that's sort of the calculation of the very, very bad going from very, very bad to just bad. And you can catch a lot there.
Oh, so the last two times coming out of recession, one of them was COVID induced. So we had a COVID induced actually recession, or probably call it depression, when you shut all the businesses and stuff like that. So coming out of the COVID one, I don't to my own horn, but I did a pretty good job because I'd already seen the movie before. And so we bought companies that had been shut down, whether it was casinos, we got into the steel industry, things like, as you look at the fund today and look, wow, you got chips, you got this, you got that. But there was a period there, if you go back, where the strongest relative earnings were in casinos, were in steel companies, chemical companies, stuff like that, because as I said, the fund follows strong relative earnings. I do not dictate the themes, and I do not dictate the sectors. So we've been overweight utilities, we've been overweight REITs, we've been overweight utilities. The only sector of the sectors that have never been overweight is staples. I've never been able to find a scenario where I've been able to get overweight staples. But other than that, we've used all the different tools in the toolbox to create a good tasting stew of strong relative earnings at attractive prices.
Is it an interesting time to be bullish on a lot of different things? I mean, we do talk a lot about AI, so it sort of feels like that takes a lot of wind out of other sails, perhaps. But in fact, is that becoming more nuanced?
Oh, completely nuanced. So as we talked about industrials versus tech, so AI started in tech, but it's had a disproportionate influence on industrials, and it's heading very quickly into healthcare. And
you always invest in healthcare, I recall, or you always have an interest generally in healthcare. Is that right?
You give me a good healthcare product, I will, or device. I'm very interested. It's a great. The population is aging. and people are living longer, and so the ability for people to spend more money on healthcare during their lifetime is going up. So the healthcare industry grows almost double digits, and double digits is a hard type of growth rate to find in a lot of other places on a consistent basis. So one of our bigger holdings is Eli Lilly in the GLP-1 area. It's been there for a number of years, and so that's something I always look for.
Okay, fascinating. Really, really interesting area just to kind of get into, and that seems to be spreading. There's lots of new competition going on there. So to the extent that we've watched, some will say some real tectonic plates have been shifting over the last week or so, couple of weeks. I don't know if you agree with that or not, but just speak to sort of the ability to be flexible. I mean, you pivot and you've described that, but sort of how you do that on a daily basis, basically, if you have to.
Yeah, on a daily basis, you just do it you get to kind of do it one stock at a time. So today we have earnings from a number of companies that you're listening to them, and you're basically the key. What I try to do is 36 stocks, and we're fully invested. So as I listen to earnings of the ones I own and the ones I don't own, you basically compare the upside, downside, and the durability of their earnings, and if you have a better soccer player, you swap them out, and so that's how the portfolio kind of evolves. You don't dictate. I don't dictate. You know what? I'm going to go all into industrials out of technology. I'm saying, you know what? Look at this company, Eaton. Eaton Corp is doing a better job than this technology company, whatever, X. And so I sell X and I buy Eaton. And next thing you know, we've now moved the weightings a little further away from tech and more into industrial. So it's a name by name basis. And then when at the end of the quarter, every 6 months, you look back and you say, wow, you're now more this. So I'm not dictating it. I am taking what the market gets to me, and we're heading into earnings season now. And this is my crunch time. I listen to the calls and I try and make sure that my shareholders have the exposure to the best names at this time, and that changes. And so that's why I have to do the calls, and that's why I have to make trades.
It's endlessly interesting earnings season. There's just goodies everywhere. Before you go, do you see green energy as another? We started talking about 10-year trends, themes. Do you see green energy as another 10-year theme, perhaps? Is there opportunity there?
Yes.
We thought we'd ease off with a really easy question just to round things out, before we let you go.
I believe green energy has a position in the energy production in almost all countries. The speed with which it's adopted, I think, is going to be slower than people had anticipated for a number of reasons, and could be held back depending on the presidential election. So markets tend to take a lot longer to develop than people in DC want to say. We're now going to be 12% solar, 15% wind, and they dictate mandates, but they don't take into account that you need to build the stuff, you need to create power lines, you need to have backup power,
so
you need reliability.
I'll just hold you there. The answer is yes, but it might take longer. We'll have to jump. I hope that's all right.
Okay.
Steve DuFour, thank you for joining us.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.